All right. Well, wow. The market sure seems like it's heating up already as we head in before the holidays. Late summer, it looked like things were moderating a bit. Demand was backing off, inventory is building a little bit. Some of the real hot signals in the US real estate market were cooling off a bit, getting a little more normal. But man, it sure looks like now that that's no longer the case. So that's what we're looking at for 2022. And that's what we'll spend time with today. So welcome to the December Altos Research webinar, the outlook for the 2022 real estate market. Every week Altos tracks every home for sale in the country, all the pricing, all the changes, all the supply and demand metrics. And then we bubble up that data for you, especially to be able to work with buyers and sellers, with investors, people who have exposure to the real estate market and need to understand what's going on right now. So we're going to spend our time today looking at all kinds of things, as much depth as we can. A little housekeeping before we start. We have Jeff and Lael from the Altos team in the chat. So we have several hundred people on the call today. And so if you have questions along the way, you have questions about the data, you have questions about Altos Research, about how you can get the data, market reports, et cetera, for yourself, drop that in the chat and we will be sharing links and answering as best we can along the way. So use the chat box, and Lael and Jeff from Altos will be in there responding as quickly as they can. All right. So a little bit of what we're looking at today. So the market sure seems to be heating up. How can that be? Why is that it heating up before the holidays? Normally you'd expect that in January, but really, why is that happening right now? And what can we see? We have lots of leading indicators for the market in 2022. We can already see a ton of what's going to happen in the market for next year. So we'll look at those leading indicators and we'll see how far out we can see for the year. One of the big questions facing us right now are mortgage rates. They're still ultra low. They ticked up a little bit this year. And a lot of us expect rates to climb this year. So what happens to our market if rates climb, if it gets more expensive for our home buyers? But here's another interesting question. What happens if rates fall? And I'm going to show you some data that actually might be compelling to think about. That's something we really should pay attention to. What happens for your buyers and your sellers if mortgages get cheaper this year? That could be really fascinating. What are some other risk factors that we may be facing for 2021? And I try to frame, as we're looking at the data, how we can help clients through their fears in through their fears. My microphone okay? Yeah. How we can get our clients through their fears in the market when they're worried. Buyers are worried about are they buying at the top? Sellers are worried, have they missed the top? Is it too late? So we started 2021 with everybody in fear. What's going to happen with the pandemic? Now we're a year on and everybody's afraid. What's going to happen after the pandemic? The key here is that the data is how we answer those fears, how we best inform our clients to make the best decisions they can. And then of course we finish the hour with a few local trends and seeing if we can see some differences along the way. Okay, so let's start with some data. Let's start with inventory. So here, there are currently 339,000 single-family homes on the market. That's falling pretty rapidly. It always falls pretty rapidly this time of year. The holidays, fewer homes get listed at Thanksgiving. Then again, as we go into late December. So fewer and fewer homes. The inventory typically hits the bottom in the second week of January. Some years it might be February, where it bounces along for a little while before February ticks up. During this year, we didn't hit our low in inventory till April 30th. We had any new inventory that was getting listed in the first quarter was getting gobbled up so quickly that inventory actually kept falling. So we had our lowest point, 307,000 single family homes on the market, April 30th. And right now we're looking at that we're about to break that record low. And I'll show you how the forecast looks for that in a second. Before we dive into the forecast, one of the things I want to mention about the Altos inventory number. I have some questions sometimes. People say, why is the Altos number different from, for example, the NAR number? And it's an important thing. So NAR may announce that there's 1 million homes on the market, and we're looking at 339,000. What's the difference? There are three big differences between the Altos number and a number like you might hear from NAR. The first one is that the Altos number we're measuring, if you walk into the market right now and you look around, you will see 339,000 single family homes on the market. When NAR announces their number, they'll announce the November inventory number. And in that, they will include active inventory, but they'll also include homes that are pending that might have been on the market in November. So the difference is by including those pendings, all of a sudden their inventory number is way bigger. But it turns out you can't buy those homes because they're already pending contract. So, and because they look at a month, they look at all of November. If a house is listed, for example, November 7th, and it gets an offer November 10th, by end of November, Altos, that's no longer active inventory in the Altos number. But in the NAR number, that's still counted as active for November. So what you're going to see is bigger numbers because they tend to be looking backwards. What happened in November? Where Altos, the Altos number is like, if we look at the market right now, this is what we're seeing. The headline numbers that you might see from other sources will tend to include both single family homes and, for example, condos and townhomes. In the Altos number, the stuff we're looking at here, the data we're showing here is single family homes only. In your Altos reports, the condo data is a separate tab. It's just another tab in there. So we like to have them as separate data points, separate trend lines for you, because the condo market may be behaving very differently from the single family homes. So it's easy for us to talk about single family homes here, but when you're comparing apples to apples, that's something to keep in mind. And then finally, there are things like new construction. So if you're in a market, one of the things that's interesting right now is that we have, in many places, the most new construction properties under construction that we've ever had. Like, builders are finally building homes. And while you can buy those, you might not be able to move into those for a year and a half. And right now that time is extending because of the supply chain problems. So what we're doing with this number is these are active, existing single family homes, so that if you want to go buy a house right now, this is what you can buy. That's what we're looking at here. And it's important to know that for your buyers. When you look at an Altos report, that the whole Altos report is, if we walk into the market today, this is what we're going to see. We're not going to see houses that sold last month. We're not going to see things that are pending. This is what you can buy. And this is, if you're a seller, This is what your competition is right now. So that's the inventory number. When we look at the forecast, here's what we can see. Each line on this chart is a year, and you can see that it declined just a little bit more in January before rising, typically peaks right at the beginning of January with the most new listings in the second quarter. And then we see it starts to decline for the second half of the year. You can see this year is the thick line at the bottom, the red line. And we had a normal curve this year. We just have significantly fewer homes on the market. We went through the pandemic, everything came out of all of the demand just spiked up. So we have the lighter red line where inventory declined all year last year. Now we have a normal curve. And so we can see the forecast the rest of the year and into January. And what we can see right now is that we will start January below that record low point of April 30th this year, and probably decline a little bit more in January, so that we're going to start the year with record lows. And it's going to be very difficult for us to have anywhere near the normal levels of inventory for 2022. What that means is we can already see in the data that supply is restricted for all of the whole year. We talked about rising rates. If rates rise, we can see in the data where, for example, the last time mortgage rates rose was 2018, and you could see inventory build a little bit that year. In this case here, 2018 is the yellow line. And you can see the yellow line started off on the left side of the chart here, pretty low. And then inventory grew through the year, and it finished a little higher than the other previous years. And you can see, like, that's the difference of mortgage rates rising by a full point in 2018. So you could see we could shift up the inventory, but it's not a spike. It's not a drastic change. It's like a little bit of change that we could see at that time. That's what we're in for 2022. We're already in that case. And one of the leading signals, therefore, is that no matter what happens with rates, with the rest of the market, there's very little opportunity for a lot of inventory to build. This is the demand side. What we see here is we see the measure that we've been tracking at Altos this year called immediate sales. So the homes are getting listed and they're taking offers essentially immediately within hours, or maybe just a couple of days, and they're going into contract right away. This phenomenon has always taken place. Like in hot markets, there's always, immediate sales that happen. But in 2021, it became a dominant force in the market. So the light colored part of the line here these are all of the listings that went into contract immediately. And you can see each week all year long. The dark red are the other new listings that came to market and stayed on the market. So right now, this week, 21,000 of those homes went into contract immediately, quote, immediately from that case. And what's been surprising to me is that I expected our immediate sales to trail off as we went into the holidays, and they have not trailed off. It's one of the things that lets us say that it sure seems like demand is increasing again. We watched it maybe cool off a little bit in the fall, but it sure looks like it's increasing again before the holidays, which is a surprising time. And so I have a quick poll that I'm interested here. I am interested in your local market. Have you seen in the last couple of months in the winter, do you see things, for example, like multiple offers, other immediate sales, competitive buying? Have you seen that accelerating in the last few weeks? Have you if you've seen, for example, in our case, so in the data, it sure looks like things are accelerating, but maybe in your case, it's not so much. So I'm interested in seeing anecdotally what you see. And we'll let people vote for that, and then we'll share what that means. So click on the poll, answer, things like multiple offers. Are those things increasing right now from the fall? All right. Let a few more people vote, then we'll share the results. These polls are always so interesting to me. Okay. Maybe the market in your area is it seems like it's still cooling off. That'd be interesting to know. All right, on a second here, let's share the results of this poll. All right, so 43% of you say it's staying about the same as it was late summer. Now, maybe that means that it didn't ever cool off in late summer, but 41% of you feel like the demand is increasing this winter, and only 16% decreasing. So that sort of like you'd expect the demand to decrease in the winter through the holidays, but so what we're seeing are unseasonable rates of demand. That's going to translate into things like the headlines that we start seeing in January, February, March of actually accelerating transaction rates, like they're very bullish headlines. So it's one of the leading indicators that we could see right now for transaction prices and sales rates and all of those headlines numbers all the way through the first quarter. Really something to notice. Okay. On to prices. The median price for a single family home in the US right now is $375,000. That is flat from last week and declined off the peak from the summer. And you can see in the chart here, every year has its cycle where the best inventory with the strongest pricing happens through April, May, June, peak in June, July, and then backs off. Last year, we had that real strong demand way late in the year. And so prices didn't really back off at all late in the year. And it's why home prices ended the year with such a strong gain. This year, we had a strong fall. We have had a little bit of price adjustment that's more in a normal seasonal pattern. But now we're seeing the demand kick in. So it's unlikely that that's going to adjust, any further down. We get a little bit during Christmas and New Year's, one more dip, and then the January will start climbing again to new highs. What that shows us here is that we can already see that the transaction prices, we're going to see the end of the year is wrapping up at about 10% home price gains year over year. That's the second year in a row for 10% home price gains. And really what that means is that, all Americans have a lot of equity in their home. It's a really big asset. That equity, combined with the low mortgage rates, is actually one of the reasons that we have low inventory. I have, for example, if I have a home and I want to buy another second home, I want to move, it's a really good time to keep my first one as a rental property. My costs are low, my equity's high, like I have a really good opportunity to have now own two properties. And when I own that, property, I don't sell it, I don't list it. And that's why inventory falls each year, because Americans more and more are turning their homes into investment properties. They're not selling them, they're keeping them. And each year, if you looked at that inventory chart, our available inventory declines year over year. That's not changing yet. So that's why we can already see that 2022 is going to start with record low inventory. The light colored line here is the price of the new listings. Each week, a new set of homes gets listed. And what we're watching here is where are those priced? And what happens is the economists call this the wisdom of the crowds, where the crowds being sellers and listing agents, they know exactly where to price their home because they know, for example, that demand is increasing, multiple offers and things are increasing in December. So when I go to list my home the second week of January, I know that the demand is there. We already know this. And so sellers get to price a little more aggressively. If that were turning, if we looked, for example, and we were seeing our immediate sales start to fall, then sellers would say, aha, there's fewer multiple offers. They're not going as quickly. I'm going to price at a little discount so that I can see, so that my house doesn't stick around on the market, it doesn't sit around. We want to get this deal done. And so that shows up in this light red line. So now each week, the collection, so every house, any given house may be over or underpriced, but in aggregate, they're priced exactly where they're going to sell. So what we see is we had one dip for Thanksgiving. We have a rebound this week. We'll have another dip in the new, like anything that gets listed in the next couple of weeks, right around Christmas, would get listed at a little bit of a discount. So you'll see the dip, and you can see every year has its end of year low point right at Christmas. And then this one, this light red line here, the lighter colored line here, is always fun to watch in the second and third week in January. So if you watch the Altos weekly videos, it's going to be fun to watch this in the second and third week of January. You can see how quickly that jumps up. And you can see the line last year, the last little dip from 299 right now, a year ago. You had your New Year's dip, and then a real steep climb in January and February. So the new listings said, wow, there's a ton of people out there buying. We're going to price a little more steeply. We're going to get that premium. And then they started getting the premium. So the next lists, the next few weeks, kept ratcheting the price up. Prices climbed very quickly. And what that told us was that the transactions that were going to happen, these are just getting listed in January and February. So these are transactions that happen in March and April, and then May and June. We could already see by the second, third, fourth week of January that prices were going to be super lifted for all of 2021. So this leading indicator is going to be one that's super fun to watch as we roll into the new year. And it's one we can already see strength. If, on the other hand, we were looking like a bigger dip here, if, for example, maybe something scares off buyers in the next few weeks and all of a sudden prices start to adjust down, you'll see it here, and that will adjust a forecast for home price appreciation for all of 2022. Let's look at some more demand indicators. Days on market. So when we're looking at the median days on market of all the homes on the market, usually this time of year, homes are taking longer to sell. And this year, the curve is the same. You can see each year here starts climbing. The days on market peaks in January because then you start getting new inventory, you get new buyers in the market, and those transaction times fall all the way through the second quarter. And then the lowest point of the year is in May and June. But after June, typically, then now that if they haven't sold yet, you start getting price reductions, you start getting people worrying about school starting, all these things happen. So here's what we can see from the days on market as of right now. We're currently 49 days median. That's lower even than last year at this time. Usually, last year at this time was like 55 to 60 days. And so But we've got a little more climbing to do before, January, mid-January, another month of climbing. Normal for this time of year might be 85 or 100 days on market. As homes sit, anything still on the market over the holidays would sit around and then, not get its action until January. Last year proved that that did not have to happen, and that transactions were going to happen over the holidays. And it feels like that's going on right now as well. What we can predict from this chart, from where we're ending 2021, starting the next year, is that we can see that we're going to get at least back to our record fast time on market by May, and maybe even faster. It's hard to imagine it getting faster than 21 days, median. We had a lot of markets with essentially 0 days on market was the median, like homes getting listed. They're all essentially immediate sales, or the vast majority of them were immediate sales. It's hard to imagine that going further than that, but we are looking at record fast time again by April, May, June of next year. That means for your buyers that competition is going to be increasing through the first and second quarter. It could mean that if you've got buyers looking now and they see a property they like, but they're worried about, do I make the offer now or will I get better opportunity this spring? Inventory generally climbs in the spring, and so often you might advise that there are more properties coming. What it looks like from this data is that their competition is going to increase this spring, and it may be wise counsel for them to take action now if they have the home that they can afford that they like now. It may be wise counsel to say, this is probably for the next 6-8 months going to be the least competition you're facing. Something to think about in that case, especially if you've got buyers on the fence. We can already see it in the data though. So even if there are things that slow the market down, inflation, mortgage rates climbing. If mortgage rates climb, they start climbing now. I'll show you in a few minutes how that takes a little while. So they start climbing now. Now that it takes a few months before mortgage rates start to climb, and therefore things feel more expensive, and a few more months to really slow down demand. That's already the second half of 2022 before we even see any impact of that. So that's what the days on market is telling us right now. If you're looking at the data, you're listening to the videos, and you're working with clients, some clients are afraid of all the numbers that they're talking about, which is totally okay. We have at Altos a simplified version, and it's called the Market Action Index. It's at a glance answer to how's the market. Any zip code in the country, you can open your Altos report and immediately answer the question, how's the market? You get two things in the speedometer view here. You can see, this is the national reading right now, it's at 58. That's a strong seller's market. Anything over a 30, 30 is about balanced inventory to demand. As inventory shrinks and demand ticks up, that speedometer starts rising. So you can see here is not only is it strong seller's market, it's actually ticked up from last month. The gray is last month and the red there is this month. And so, this is what we were talking about when we did our poll. We noticed, this is one of the things we noticed, that in December, the market's actually heating up a little bit. And it was surprising to me to see it. So that's why I was asking, Are you seeing it as well? And it turns out that almost half of us are seeing that as well. So any local market, you can look at the little speedometer, open it up. I just want you to look at one number. If this number, for your buyers, if this number is ticking up, that means your competition is increasing. That's why now might be the right opportunity to take action. For sellers that are worried about maybe, did I miss the peak? So for sellers, while I have your house listed, I'm going to put this report in your inbox every Monday. I want you to look at one number. If the market action index falls while we have your house listed, that's the market giving us a signal that your seller competition is increasing and your buyers are maybe fewer. That would be confirming the fear that you have. And as a result, it might mean that we need to do things like price reduction if your house hasn't sold. But the good news is that the market is going to tell us every week whether or not your fear is realized, and your fear being, I'm going to sell. Have I missed the peak? Am I too late? We can watch it. We can watch it every week, and you'll know exactly what to see. So that's when you have your Altos reports. You put that in their hands and you say, I want you to look at this one number. Very telling. So this one, nationally ticked up in December. This is what the market action index looks over time. Each year, you can see the wiggly line here, the light colored line, that's the weekly reading. The dark line is smoothed out. So you can see the trend line. Each year it peaks in the second quarter and then starts to decline a little bit as transactions fall in the fall. This year, we had this massive demand spike. We had the initial pandemic reaction where, right at the start of lockdown, things, transaction volume, everything fell, but it's only like 4 or 5 weeks before we could watch that rebound. And so if you were working with sellers or buyers at that time, remember, they may have thought that the market was shut down, but we could see that everything was already taking off, and you could see it in the market action index. You could see this January, February, this massive demand spike to record levels. And what we can see right now is the weekly readings are above the trend line, and you can see it ticking up already this time in December. So when we look at multiple years, you can see not only how high the demand is and tight supply is, but also that it's increasing, and there are no signs yet of demand weakening. By the way, if you're listening to this and you need to be able to communicate with your buyers and sellers and try to understand the data and learning about the data yourself, we have an ebook, how to use market data for your real estate business. It's got scripts, it has ideas, it has strategies for communicating the data. If you haven't already downloaded the ebook, go to the link. There's a link in the chat. You can just click through that right now. Go download that. Make sure you have that so you can understand how to communicate with all this stuff that we're talking about now. One of the demand indicators that we like to follow closely here are the percentage of homes on the market with price reductions. If you are working with people who think a crash is coming, a lot of times they look at price reductions around them and they say, oh, the price reductions are happening. That means the market's cooling off. And here's what we can see. Each line here is a year, and you can see the fewest price reductions are typically in March. That's when we have the most new inventory. Then as inventory gets old, if you haven't sold your house by June, July, you start cutting the price. And so price reductions increase. Where we started this year, we started at record few price reductions, meaning normally about 35% of homes are overpriced. Sometimes that's, that's over aggressive sellers. Sometimes it's strategic, whatever the reason, you take a price cut before you sell. 35% of homes. In a hot market, maybe some of those folks say, well, let's try to get the higher price, and some of them do. So only maybe 25% need to take a price cut in a hot market. So 35% think they're overpriced, but only 25% need to take a price cut. So in the last year, we had record few price reductions. And when we have record few, that's because there were overbids, it's multiple offers, all of those things happening. And you could really see, therefore, what was going to happen with transaction prices. We could see it in the price reduction data before the transactions have happened. And that's the leading indicator here. These are deals that have not happened yet. Then we saw the late summer and the fall, price reductions started to normalize. They see the dark red line here climbed over last year. And I thought we were going to get back into our normal range. And then all of a sudden, October hit and the price reduction stopped happening. Now we're in the time of year, there's fewer new listings, and so price reductions fall to aim to the spring. Here's what we're looking at. What's fascinating is that price reductions look like they are going to start the year at or below this year's beginning of the year. And we're going to aim down to a record low in price reductions again. So this is one of the signals that we can already see the first and second quarter transactions that have not happened yet. There already enough demand so that the house is on the market now. It doesn't need a price cut. It gets an offer at the end of December. It closes in January or February. Those are transactions that are 2 months away. And we already know that they're going to stay elevated because they don't need to cut their price right now. So this is one that surprised me the last couple of months. It's declining faster, that there are fewer price reductions and they're declining faster than I expected. But it also tells us that the first and second quarter are already baked into having low supply and high demand. And what's fascinating about this cycle is that most of the year's price gains happen in the first and second quarter. So you can already see that 2022 is basically going to be an 8% or 10 in this another year of this like 8 to 10% price gain range. If rates rise later in the year, demand falls, you could see you'll see it very quickly in the price reduction data. Like if price reductions start to climb, you'll see it in the 2018. So the yellow line here, the light yellow line is 2018. That's when rates were rising. And you can see that 2018 finished the year with the most price reductions of any of the last 6 years. And that was because, and just a bit more than the other years, but it was most. And that's when rates rose from 3.9 to 4.9%. That's the impact. And you can see it happening here. So it's something to watch. When people are worried about what's going to happen with rising rates. Well, I can tell you what's going to happen. We will get a little bit more inventory. We will have some more price reduction. But because the market's so hot, we'll move back into normal range rather than to some kind of catastrophic scenario. On the other side of that coin are price increases. Here's what happens. There are investor flips. There are strategic things that happen. Sometimes around the holidays, there was a withdrawn listing around Thanksgiving to bring it back on the market in January. Now in January, we say, wow, there's actually a lot of demand, and we actually price the home higher in January. Now we can look back and say, aha, there's a price increases. So you get an normal yearly cycle. It normally climbs after the new year. We get stronger listings. It's time for flips to come back on the market. But it's usually a couple percent of the market is on the market with price increase over where it was recently listed, 2 to 3%. After the pandemic, all of a sudden we had this big surge of price increases. And then at the beginning of this year, now it was like, oh my gosh, everything is super hot. So as much as almost 8% of the homes on the market had been back on with price increases. A lot of investor activity, a lot of flips happening, and a lot of people leaning into that price increase. That normalized this year. And so we had fewer of those, and that actually is healthy. Like, you don't want too, like, that frenzy peak is not healthy. Too much speculation; those are bubble burst fears. So watching that decline back down to 3% or so this year was actually encouraging to me. Now, what's weird is that it's before the end of the year, and price increases are climbing again. Again, this is another one of those signals that shows us that really there's a lot of demand out there already setting up 2022 for the big gains. Before we switch into mortgage rates, then we're going to do some local market. I want to remind you that every Altos report, we look at the market in price range segments. At the bottom of your report, you'll see price range segments. The high end of the market may be behaving differently from the low end. And what we can see right now, these are the national segments. So the high end of the US, the most expensive 25% of homes in the US are about $1 million. Middle of the market is right there, just under 400,000. We've got and then the low end in the US is about 150 or under 150. And what we can see, for example, is what that means. The middle of the market, those are 3.2s or 4.2s homes. They are on quarter acre lots. Right now, if you look over on the right-hand column over here, the days on market, you can see that the 42 days is where we are for just 42 days for the middle of the market. High end takes a little bit longer, and the low end takes longer. There are a lot of markets where the ultra low end is a lot of junk, and so it actually takes longer to buy. And so the sweet spot in the market is right here, in this 300 to 400,000. And in your local market, you can look at your segments, and so you may have a seller that's worried about the market slowing. And you could say, well, in your price range, we can see that we're in the fastest transaction time. Or maybe they're selling the $1 million house, and we need to say, if we don't price it right, remember, their home could be on the market for a long time. You can see the median at $1 million here is 70 days. This is not an overnight sale if we don't price the property right. So it's an opportunity for you in that listing presentation to really frame the conversation well, the expectations about what's happening in your market right now. That's what the market segments are for, and it's on every Altos report. By the way, in that ebook, we talk about the market segments too, so you can learn how to talk about those. Let's look at mortgage rates. In the last few years, so this chart is mortgage rates over the last 10 years. I've talked a couple times today about 2018 was the last time we really had rates rising, and you can see rates rising here, that sort of peach colored line right there, the peak at the end of 2018. You can see rates rose all year long from 3.9 to 4.9%. And there's a couple of lessons here. If we get into a rising rate environment this year, it actually takes several months for rates to rise significantly, maybe 6 months before we realize, wow, rates are actually up higher. And it may be a full 8 months or more before the market starts to feel expensive. So for sellers, everybody who has a 3% rate right now, and they want to buy the next house, now if rates climb above 4.5, it might feel expensive to them. If we get in that environment, though, what you might learn is that for new buyers, first-time home buyers, we have the opportunity where it doesn't feel expensive. It just is for them. There's no comparison. So for the resale move-up buyer, now the new rate is more expensive. But for the first-time buyer, that's just the price. So if we get into a rising rate environment, it may be the opportunity for you to shift your targeting to first-time home buyers, where first-time home buyers still want to get in. they still, and if they have slightly less competition from the move-up buyers, the resell people and investors, that's a good thing for first-time buyers. So that's one thing that may be an opportunity for you if we look at rising rates in 2022. One thing to keep in mind for me is that I keep expecting rates to rise, and they haven't. They rose a little bit this year, but they've basically held steady right around 3%. And as we look in the future, how do we know if rates are going to rise? So my answer is, I don't know what rates are going to do. This is a chart here. This is fascinating. Len Kiefer is the assistant chief economist for Freddie Mac, and he does excellent work with data visualization. Each of the dotted lines here, the little color dotted lines here, are the forecast by the economists of where rates are going to go in the future. And notice how they always forecast up every year for 30 years. Every time we look at rates, we generally forecast, we think, wow, rates are low, they've got to go higher. And in 30 years, rates have mostly gone down. So one thing to keep in mind this year is, what if we're not in a scenario where rates climb? What if we're in a scenario where rates fall? What does that do to your buyers, to your investors? What does it do to people who are thinking of buying now? So we get in a situation where they're like, I'm thinking of buying now. Maybe I should wait for less competition in the future. But if we get in a space where rates fall, now we have more competition in the future. Right? It's like we could be facing an accelerating demand this year, if that's to be fathomed. Here's the thing to keep in mind. We always look at rates. We feel like rates are super low, and therefore rates must go up. It turns out over 30 years, rates mostly go down. So something to keep in mind, it is not a foregone conclusion that rates will climb this year. They could. So inflation spikes, that rates may have to spike along with it. That's a real scenario, but it's not a foregone conclusion. More important is to keep in mind, and also to help your clients not necessarily make absolute decisions based on a forecast that they don't know. Before we switch to the local data, our mortgage delinquency rate is almost at record lows. It keeps falling, and this includes everybody still around the edges of the forbearance. So there's only 3.9% of all mortgages that are anywhere in any stage of delinquency. And it is likely that that's going to fall below the record in the first quarter. You can see it now. And so this is actually data, it says September. It's actually data through, it's actually September. It's the latest reported data. So by the end of the year, we may see ourselves below. So record few in delinquency. That means no short sales. That means very few foreclosures. That means there's no inventory coming from distressed properties to speak of in 2022. So there's no relief in sight for home buyers based on this, based on any opportunity that way. Okay, let's switch over here and look at some reports. Let's look at some local markets. I just have a few in the South open today. This is Houston, and I was bringing up Houston. I'm just interested in, Houston is a market with a lot of investor activity with, you can see here are price increases. So when we do flips, you can see that in the Houston metro market, the 9% of homes have had price increases lately. That is because there's a lot of investor activity. We know that inventory is declining, which normally would this fall. We can see the market action index. Remember, I just want you to look at one number. The market action index actually ticked up this month in Houston, the Houston area. If we look at pricing over time, you had a strong year of pricing for Houston. You can, in your Altos report, you can change the stat that you're looking at there. And then let's look real quick at the market time. In Houston, anything under 400,000 is moving very quickly. And this is the longest time of the year, remember, too. So we're going to look at record. This is how we know we're already going to be at record low market time in the spring. I've been talking with folks lately who deal with a lot of investor activity in places like Memphis, Tennessee. And they like that because in Memphis, the median price in Memphis is only $115,000. The new listings coming on is a little more where the activity is. This is looking at Memphis inventory over the last few years. Normally 1,300 homes. This year, half of that, we had 400 homes at the peak of the frenzy in May, and we're likely on our curve for that again this year. So, and you can see, so Memphis is one of these markets where the real junk down here, 59,000, is on the market for 100 days. Like, you can see exactly where the activity is in Memphis. And this is city of Memphis proper. So, as opposed to, say, the surrounding area. And you can see exactly what we're buying for these prices. And even the high end in Memphis at 35 days. So Memphis is a real active investor market, and super strong, and staying about flat in terms of the market action index, month over month. And then I also have Bentonville, Arkansas. I have a friend who moved to Bentonville, Arkansas recently. I was interested in Bentonville is where Walmart is headquartered, for example. And there's actually a lot of high-end homes like executive level homes there. So, in Bentonville, the median home price is actually $600,000. We can look at the days on market in Bentonville and see how much faster things have moved over time. And I was looking at the days on market in the market segments. So what we have here, the red are the cheapest homes in Bentonville. And you can see during the year's frenzy, what happened was even the most expensive stuff in Bentonville, the market time just cratered. So right at the peak of our buying season this year in May, everything is going in 30 or 40 days, even the over $1 million homes in Bentonville. When I say things cooled a little bit this fall, you can see the more expensive, the green and blue lines here started taking longer to sell, while the cheapest stuff in Bentonville has not climbed. So when we're working with clients, like, this visualization is very powerful. We went from this time where, it might take 6 months for the expensive homes in Bentonville to sell to all of a sudden 30 days. Like, that's a big deal. And you can feel it very directly in those local markets. You can always use a search box in your Altos reports. If you go to the Altos Research website, you book time with our team. We didn't have time maybe today to look at your local market. We don't have time. It's 5 minutes to the hour. Go to altosresearch.com, book time with our team, and we can look at your local markets. We can interpret the data, help you look at the numbers and see what you might need to be telling buyers and sellers right now to help them take action, to help them make the most confident decisions. So we cover every zip code in the country. So that's where we're going to wrap it today. 2022 is looking, as far as we can tell, all the leading indicators are actually showing accelerated demand, not decreased demand. There are some risks. We didn't even get a chance to talk about things like new construction and the fact that there's a ton of new construction in the pipeline. but and rates might rise. So there are definite risks to the market, but as of right now, all of the leading indicators are showing another super strong year, and in fact, maybe even accelerating. And so it may be, we may be at the opportunity might be right now for our buyers, because competition's only going to heat up. Okay, that's all the time we have for today. Thank you so much. I appreciate you all. Stop by Altos Research and book time with our team, so make sure you know how to talk about the data with your clients.